Nilesh, fantastic to have you back on ET now. Thank you for joining us. Now, Nilesh, before I come to you for a question, I just want to establish a trend for the benefit of our viewers, and this is a big trend. The big trend is that domestic institutional investors are now really supporting Indian markets. For the longest time, Indian markets have been dependent on global flows. Foreign institutional investors, even though they've been our fair feather friends, but in last one quarter, more than FI selling, it is the DI buying which is making all the difference, and courtesy the SIP culture and the fact that LIC has been massively buying into Indian blue chip stocks, domestic institutional investors are now called as the original price makers of this market. Nilesh, you've been talking about this trend, and now that trend is firmly established. It's heartening to see that Indian markets are no longer a one-trick pony, and we are now not only dependent on foreigners.
Yes, Nikunj, it's an extremely important trend. For almost last many years, we have been talking about retail investors shifting their savings from physical assets to financial assets. On a thumb rule basis, they have about $10 trillion worth of real estate, between $2 to $2.5 trillion worth of fixed income assets, probably between $1 to $2 trillion worth of gold, and just about $350-400 billion worth of equity. And we know equity is a Ferrari car. It runs at a much faster pace. So all these years it was painful to see that people are happy to put money in assets which does not necessarily give real return, but are ignoring an equity as an asset class. And now, as you correctly mentioned, we have seen SIP culture coming back. There are more than 78 lakh Indians which do SIP. A lot of it has started in last 1 year, and my request to all of them will be to continue their SIP and not stop it even if there is a correction in the market. And now we are seeing not only the insurance companies, mutual funds, retail investors, but also the provident fund money which has started taking baby steps to come to the market. So now it's no longer just two pony, it's a full-blown horse supported by retail investors, insurance companies, mutual funds and provident funds. I mean, clearly there are good days ahead for equity market from domestic investors' point of view.
Well, Nilesh is exactly voicing what the big investor Warren Buffett from Berkshire Hathaway is saying that activity is the enemy of investment returns. And that's exactly Nilesh's word of advice to all the retail participants out there. Don't pull out your SIPs just yet. Stay put. There are good times ahead. So Nilesh, one talks about the nitty-gritties and the daily moves of the market. You're trying to say that there is not to worry about the FII outflows so far. They will return in the near future.
My feeling is that as long as we can deliver economic growth and corporate earnings growth, which is better than our peer group, there is enough liquidity in the outside world which can continue to support our endeavor. More importantly, if we can actually stop consuming gold, then probably the surplus money which will arose in the economy because of non-investment in gold is good enough to take care of any FII and FDI inflow put together. So we are at a stage where domestic, institutional and retail investor participation is increasing. The gold lending scheme draft norms have been announced, and if those are executed well, we will actually see surplus arising out of gold coming into equities or probably fixed income market, and that will reduce the dependence on the foreign direct or foreign portfolio flows. At the end of the day, if my economy and my corporate earnings are good, I'm sure there are many investors who will be happy to invest in India.
Fair point. So, I was just ticking down the points that we were trying to speak to Nilesh about. Do we have to worry about FI outflow? We probably don't have to. Is the government doing enough, and what does it bode for the future? I think he's given us an inkling. The question, Nilesh, is whether the market was expecting too much, and now that the expectations are sort of reset, is it actually a good thing that has happened?
I think when the new government came to power, people had high expectations from them in terms of delivery, and obviously the delivery has to happen through a fairly elongated process Now they have taken certain steps in terms of inflation control, in terms of encouraging domestic investment through Make in India and defense contract kind of schemes. Now those are all the things which have kind of given confidence to the market that yes, going forward there will be better days ahead. What market probably kind of expected little bit more, has been corrected in last 1 month or 2 months correction, partly driven by FII outflows and partly driven by valuations running little bit ahead of the quarterly numbers. If we see the fourth quarter FY15 numbers, the turnover growth for about 72 odd companies in the large cap category is just around 8%, and the profit growth is also averaging around 8%. Now certainly this lower profit growth than probably expected by the market to support the valuation of 16.5 times forward earning is also a function of lower capacity utilization, very high working capital cycle due to little bit tight monetary policy, inventory losses coming into quarterly numbers because of drop in commodity prices. Now over a period of time these things will be behind us. The capacity utilization will start inching up as government's spending on road, railway and infrastructure will come into economy. The inventory losses will be a matter of past as the commodity prices have dropped, and now that will be reflected into better raw material cost and higher margins probably. And hopefully RBI will cut interest rates which will benefit the companies which are a little bit leveraged. So definitely we see going ahead in FY16 and FY17 earnings growths to recover sharply, and that should give support and momentum to the market.
Markets, they always map earnings, and in the short term it is pretty clear that earnings are unlikely to improve or they are unlikely to pick up. So with that poor earnings backdrop, what are the chances that in next 2 quarters markets they simply consolidate and the bias remains completely flat?
So my feeling is that yes, consolidation is necessary in the markets, but that consolidation will be with a positive bias rather than negative bias. Let's look at over next 2 years, can we expect earnings to grow up by about 30 to 35%? And I think that's quite likely. If there is a 1% interest rate cut, that's straightway 7% growth in corporate India. If I improve working capital cycle because of the drop in commodity prices, because of better liquidity available in the system, that can add another 2 to 5% to the profit growth. If I improve capacity utilization by between 5 to 10%, certainly that can add another 5 to 10% to profitability growth. So while these are all one-off events, but improved capacity utilization, improved working capital cycle and interest rate cut alone could contribute more than 20 to 25% of the profit growth. And then there is a government spending in road and railway sector, in defense sector, which again will percolate to the economy. So put all these things together, can we see about 30% earnings growth over next 2 years? Little bit back-ended albeit. Yes, that is quite likely, and hence market may consolidate around current levels, but over 6 months it will consolidate with a positive bias rather than negative bias.
Nilesh, start of this year and most experts did seem to believe that this is the time when both fixed income and equities would give you good returns. So perhaps, a portfolio of 100, 50-50 should go into into equities and fixed income. What happens now? Do you juggle the composition?
So in the fixed income now I think you have got a better opportunity to invest. Over last 15 to 20 days yields backed up a little bit because of the FII outflows and expectations that probably rate cut cycle is a bit delayed, and also what happened in the global markets. Now over a period of time market has overcome that anxiety. When the German bond yields fell from 75-80 basis point to 10-12 basis point, our yields didn't decline in that kind of commensurate measure. Now when they went up from 10-12 basis point to 75 basis point, there's no reason why our yield should back up along with that. So market has overcome that anxiety. The 10-year yield today is somewhere around 783, 784, and I think that's a great investment opportunity in the fixed income. We do expect RBI to cut policy rates as we move forward into this year, and that should result into better return for the fixed income investors. Probably this year fixed income and equities will give almost similar return because the earnings growth are more likely to be in FY17 than FY16. But in the FY17 year, 1 year from here onwards, definitely equity funds will deliver far better return than fixed income fund, and which is why it's important to have your allocation between equity and debt, even though they are likely to give similar returns over next 6 to 12 months.
Nilesh, I distinctly remember last time when we interacted with you on this forum, you were of the view that it's time to buy into IT. This entire thesis that Indian IT companies will slow down and cross-currency headwinds will dent their margin, that was all a bogey. IT stocks have stabilized. Do you think that discount factor is missing, or IT stocks still have a long way to go, and in the next 1 to 1.5 years they can easily give a 15 to 20% return?
So from a business point of view, large cap IT today looks far preferable compared to mid and small cap IT companies. Second, the stock market prices can recover quite quickly as we are seeing today, but the business is going to take time to recover. My hypothesis is coming essentially from the fact that we saw a sharp appreciation of rupee against euro, yen and GBP last year. Now that's unlikely to sustain. I don't think so we are going to witness that kind of movement in rupee appreciation for foreseeable future. It's more likely that rupee will depreciate against those currencies, and rupee will also depreciate against dollar to reduce its overvaluation on a real effective exchange rate basis. So the currency headwind, which was negative for last year, will be positive this year. Now from a business point of view, obviously IT companies will have to ensure that they are able to participate in the newer horizons, which is cloud computing and what popularly is known as SMAC. Now unless until you can migrate from the traditional infrastructure maintenance and application development kind of thing into SMAC kind of arena, you are probably not going to get the valuation. And we believe today there are some of the Indian large cap companies which are already making an impact into that field. And if we see the unlisted IT varieties, there are data analytics companies which have commanded billions of dollars of valuation. So it shows that Indian entrepreneurs have the ability to move fast forward into the newer horizons, into the newer areas. And if you can capture that through the listed companies, I think large cap IT companies is a good bet. They will deliver good return going forward. But please remember that business will take time to recover. Currency's headwind will now be supportive to them.
The other thing that I think Nilesh has spoken about in the past as well, and we were just trying to bring out some interesting quotes from global managers as well. A hedge fund manager from the US, Joel Greenblatt, he's saying that the secret to investing is to figure out the value of something and then pay a lot less. This is his view. And Nilesh, this is something that you've kind of spoken about in the past as well, that it always makes sense to buy a great business at a good price if it is available. So my question to you is, we are no longer at those 9,000, 9,100 levels. Are there businesses within sectors available at a really good price? Maybe the value is great, but the price is much lower than what it should have been.
So definitely today, as the markets have moved up about 24% over last 1 year, there are fewer and fewer businesses which are available at great value. There is one segment of market which is very, very cheap. Cheap is not value. So if you see PSU banks, they are trading below book. If you see leveraged entities, they are trading below book. Now, in my opinion, they are cheap. They are not value. They are trading below book for reasons of NPS. They are trading below book for reasons of debt. And maybe few of them will become multi-bagger if things turn around, in a completely unexpected way. That's cheap. That's not value. Value is where you can see that going forward, the profitability growth of those companies will be better than what market is pricing in or market is expecting. These are moderately valued stocks. They have good business fundamentals. They have reasonable amount of debt or lesser debt, and their working capital cycle is going to improve. Their operating leverage through higher capacity utilization is going to come in, and most importantly, today they are available at a PE ratio which is lower than what will be their profitability growth over next 2 years. So to me, that is value, and which is where if you buy today, my feeling is that that portfolio will do better than this cheap stocks as well as some of the expensive stocks, especially in the consumer staples sector or pharmaceutical sector.
Okay, Nilesh, that's a lot of stuff discussed. The power of compounding, the merit in staying invested into SIPs. Thanks for that. Thanks for that reasonable distinction between cheap and value as well. It was great having you as always, and look forward to having you more often on the forum.